Hi guys, welcome to the channel. My name's Tim, and today I'm going to be talking about this section here of the Bitcoin chart. We've gone sideways for 54 days, and so far no one has really given us a good explanation of why this is happening, and no one really knows what's going to happen next, whether we go up, whether we go down, or whether we keep going sideways for another few months. No one really knows. But I think there is some evidence in the data to give us some clues about why this has happened and what is going to happen next. Okay, so if you're interested in that topic, please subscribe and like the channel and comment and hit the notification bell and all that sort of stuff. So let's get right into it. Now, first thing I want to bring up here is my favorite thing, the 50-day moving average. And this gives us some really important information right off the bat, okay? Now, I like to have it shaded in because to me it looks like water, okay? And I see it as like an ocean wave. And you can see the price of Bitcoin has bounced off this 50-day moving average on the way up, right until this point when it crashed through. So I see this as like a surfer surfing on a wave and then crashing through the water. And that's the point when they realize, okay, we're in trouble. They come up and they take a breath, and then they go down and they're underwater again. And then, they're trying to get under the wave. And then at some point, they'll come back and take another breath again. Okay, so that's kind of how I see these moving averages. Now, the other thing I want to quickly mention is the difference between a correction and a crash. So for me, these are corrections. They're corrections in that the price has gone up really high, but then it's corrected back to the moving average. And to me, the moving average is like the price that the market is willing to pay at that particular moment in time. Okay, so that's how I interpret a moving average. So the price is coming back. It's like, no, this is too expensive. We're not paying that. So the price comes back, and then it overextends. No, we're not paying that. It comes back and it comes back to the average. So that's a correction. But then when it crashes through the moving average, it's like, nah, we're fed up. We're not paying this. We're selling off. This is getting too high. It's too much of a risk to be holding this asset at this price. It's gone up too quick and too much. So we're selling off, and it's coming down. And once it crashes through, and then you get this lower high, we tend to be in trouble, and then we crash down again. And we've seen this before. And I've got another video where I go into more detail about this. So, okay, so in summary so far, we've got corrections and we've got a crash. Now, what these two things have in common is that these are both price-based corrections. But there is another type of correction, and that is a time-based correction. And that's where the price stays the same, but time is what moves, okay? And that's what I believe we've seen here. And to back this up, if you look at the moving average, look how symmetrical and round this is. It's like a nice, beautiful hilltop. It's almost like the market has said, okay, this is the price on average that we're willing to pay. At this point, okay, that's the top. It's too high now. Let's start going down the mountain because it's too risky to be holding these assets at these prices, and we need to be selling off and getting down to more sensible levels again. And it's done it in such a smooth, elegant way. So even though this looks like chaos, essentially what's happened is the price has gone sideways, but time has been correcting. So we've been waiting for time to catch up. And now we're at a point when time and the price are almost in equilibrium. And that's a really good point. That basically equalizes the market and allows the market to then decide to make a move. So the move might be we go up or we go down. Now, looking back over past history, whenever we crash through an MA, come up for a breath, do a lower high, then crash through it again, what tends to happen, and I show this in more detail in the other video, I'll quickly give you a demonstration. What tends to happen is this. So let's just extend this out. This is speculation. We tend to go down. We come up for a breath. We do some stuff. We come down, up, and down. And you could argue You could argue this is what's meant by Wyckoff with distribution and accumulation. You know, it's above the MA and then below the MA, above the MA and below the MA, until we get to a point when, you know, the price is doing this sort of stuff until it eventually equalizes, and that's when the market can then start to bounce up again. We've seen that before. I'll quickly show you in 2017. So it's exactly what happened here. We go below the MA, above, we take a breath, we go below, above, below, above, below, above, it equalizes. And then instead of going up, this time we actually capitulated down to another MA, which is the 1400 day, and then we made our way up. Okay, so anyway, this is a short, sharp video. That's all I wanted to cover today, is why we've gone sideways. And in summary, it is a time-based correction. So time has moved forward. The price has stayed the same, and that's to allow the market to catch up. So now we're almost at a point when we're at equilibrium, and a move can be made next. So I hope you enjoyed that content. My name's Tim. Don't forget to subscribe and like the channel, and I'll see you in the next one. Cheers.